Good afternoon. Thank you for joining us for today's webinar to talk about 2022 results and just the uncertainty, or at least the uncertainty I feel as we head into 2023. My name's Sean O'Brien, the president of QuickRate, and as always, I'm pleased to be joined by David Ruffin. David heads up our IntelliCredit division, and he will cover the second part of today's webinar. Just a couple of housekeeping items before we get started. One, we will send out a link with an email with a link to today's presentation, as well as a copy of the slide decks. It'll probably be out tomorrow, but we will send that to everyone who registered for the webinar. Just a reminder who we are. We do a number of different things here at QuickRate. We've been serving community banks for over 30 years, certainly the non-brokered CD marketplace, for which most of you have utilized or worked with in QuickRate in the past. QwickAnalytics, which is home to our CECL solver, and then IntelliCredit, the division David heads up, where we provide external loan review services as well as portfolio applications to help you better not only conduct your own internal reviews and annual reviews, but also analyze your loan portfolio. Today, we're going to talk about the QCBI results from 2022. Just again, I think the more I know, the less I know as it relates to what the outlook for 2023 is. So we'll just talk a little bit about some of the uncertainty. David will touch on just kind of a review of where things are with credit and an update as we look out into 2023. And then we'll just share you a few thoughts on the latest from QwickAnalytics and IntelliCredit. And of course, you can submit questions through the chat or the Q&A function at any time, and we'll take those at the end of the presentation. I thought today that we just maybe start with a few polling questions. Hopefully you'll be able to participate. Again, just trying to want to get a sense of where everybody's thinking about as we start 2023. So one of the first ones, I want to put out here for you is just what concerns you most as we enter 2023. And if you can just select one of those, is it rising deposit costs? Is it the level of interest rates? Is it liquidity? Or is there something else that probably concerns you most as we enter 2023? So we'll just give this another 15 to 20 seconds. Like I said, I have 4 of these. We did these on the coffee talk on Friday, and again, I just thought it was a good way to kind of start with where everything is. Also, if you have 2 monitors going and you don't see the polling question, likely if you click on your second monitor, you'll see the polling results. All right, so I think everybody's answered. I'll end that. We'll share the results so you can see rising deposit costs is probably the most at 51% of you, liquidity 31%, level of interest rates 13%, and credit quality at 4%. So thank you for participating. Just a couple of other questions. The second one is just a simple one. I thought about talking about NIM or this and that, but I just thought, hey, let's just go with, do you anticipate your earnings increasing or decreasing this year? And again, we'll just give this 30 to 45 seconds and then share the results. Okay, well, this is actually pretty encouraging. 60, well, no, I guess not as encouraging. 40% see it increasing, 60% see it decreasing. I'm just going to check the results. I'll share these with you and you can see those numbers. Again, 60% see earnings decreasing, 40% increasing. All right, let's move on to question number 3. Liquidity concerns. Do you have any liquidity concerns? I probably know the answer to this based on the initial question, but we just wanted to add a follow-up one just in case it didn't garner much attention in the first one. So We'll give this another 15 seconds or so. Okay. 72% of you say yes, 28% say no. So again, thank you for sharing that with us. I'll put those up, and then let's go to the final question. Credit quality concerns. Are you concerned about the credit quality of your loan portfolio? And so again, we'll just give this 30 seconds or so. Okay. 73% of you say no, and 27% say yes. So, again, I think thank you all again for participating in this. Like I said, it just kind of helps give a sense. I know, to me, again, as I said at the top, right, the more I know, I feel like the less I know. And as I look out into this year, there's positives and negatives. And so just to get some context about where everybody kind of feels they're at was very helpful. So thank you all very much for participating. We'll share those in the email as well when we send that out. Again, just the QCBI, it's our index that we use here at QwickAnalytics just to kind of keep a pulse on what's happening with bank performance. You can see, under 4,800 banks now, right about 4,756. The breakdown of those banks, you can see over the last, 5 years or so, we've lost, just about another 1,000, banks. Asset growth over the last 12 months, has increased, but at a slower pace than obviously over the last couple of years, with 37% of the banks seeing no asset growth this year. And the $1 to $10 billion banks seeing, the larger share by asset size. Median last 12 months loan growth. This is actually, again, I think encouraging and albeit yet surprising a little bit to me. 11%, with 54% of the banks in the country, community banks in the country, seeing better than 10% loan growth last year, which again I think is fantastic. But again, I will say I was a bit surprised that with the rise in rates, we still saw really good growth, kind of across the board in banks of all sizes. And here comes to the liquidity concerns and deposit concerns, right? So not only do we have the issue of rising rates impacting our securities portfolios, but then deposit growth, obviously, which had been almost in some ways astronomical over the last couple of years, still increased this year, but obviously at a much slower pace. 33% of the banks saw no deposit growth, and really no, just kind of across the board, just moderate growth at banks of all sizes. So certainly something that, we're keeping our, eyes on here at QuickRate. We've certainly seen a renewed interest from our banks. But again, will probably be a story and a theme that we revisit throughout all of 2023. Some of the performance numbers, obviously the yield on loans has come down. I would expect we'll see an uptick in that as we move through 2023. Certainly an increase in the cost of funds, which again, I would anticipate to keep rising as we move through 2023. NIM, it's encouraging to see it rise in 2022. Hopefully that will continue to increase during 23. I think that will certainly be something that we all closely monitor. We know our deposit costs will be going up, but hopefully we'll be able to pass along pricing on our loan, to our loan customers. Non-interest income, not surprisingly, with the rise in rates and refinancings down, we'll see a decrease in that. And the efficiency ratio kind of held steady at 65.5. All this translated into, again, pretty strong profitability numbers. Pre-tax ROA, median values at 119. Again, other than the $0 to $100 million banks, everybody above 1% ROA. Median core operating earnings, just a reminder, That's pre-tax, pre-provision types of analyses, again, all pretty strong. So that's all very encouraging. And that obviously translates into, a median strong ROA and ROE numbers. So, I think for 2022, as we close the books, it was really another strong year for community banks. And I think, again, gives us a good base to build on for 2023, even though 60% of us feel like our earnings will decrease, and that a small percentage may see some issues with their loan portfolio or anticipate some issues. We really are coming at this from a position of, strong capital, strong earnings, and if we get any moderation in rates, our liquidity will improve, but that's certainly at the forefront as we head into 2023. So just a couple of thoughts, as I look back over last year's presentations, the Fed certainly, last year played catch up with inflation and continues in some ways to do that. They've clearly made the choice that they're, while painful as it is, they're willing to live with the inflation rather than to throw the economy into recession by, moving too quickly. And I think, as Jerome Powell said in his February 1 press conference, right, their monetary policy actions are guided by their mandate to again promote maximum employment and stable prices. Right, it's a difficult needle to thread, but they continue to feel that moving slowly and gradually is the best approach. And in some ways, they've been right. I mean, obviously, inflation is a huge problem, but the economy has continued to create jobs. We are at 50-year record unemployment. GDP did not, still ended the year above, while a slower trend, ended up positive. The growth remains strong. Inflation's obviously higher than any of us would like it, but the consumer's still spending. The housing sector, while softer, because of the higher mortgage rates, hasn't imploded. And while we've seen, slower output in terms of business investment, the economy still kind of continues to moderate, which, again, given everything with the rise in inflation, that's actually pretty impressive. I was struck by the screenshot of this presentation last year when the 2-year was at 2.66 and the 3-year was at 3% on CDs on quick rate. Today, obviously much higher. So we are living with not only higher interest rates in the fixed income world, but now that's starting to obviously impact us in our local market rates as well. So for 2023, right, we are at 475. Last year, the expectation of Fed funds futures at this time last year was that we would have ended 2022 at 275. We obviously blew through that by 200 basis points. The Fed says they'll continue to reduce their balance sheet, but they've done that, albeit very, very slowly. And so I think their approach is they're going to kind of keep gradually working at this in the hopes of avoiding a deep recession, because that's the only way unemployment's going up, is to throw us in the recession. And so they're trying to, I'm sure they hate to continue to use the word soft landing, but that's really what they're trying to do. The consumer still is spending, as we said. I expect, I think we'll see the housing sector to continue to weaken a bit, but, I think in most markets, the lack of supply is kind of, putting a little bit of a floor. And then we'll have to continue to watch to see, hopefully, that inflation will start to moderate a bit this year as the year goes on. Again, this was a slide I had in last year's presentation where the Fed funds expected, futures had them, and you could see it capped out at 275 going through 2024. This year, the expectation is that they'll continue to rise in 2023. And then as the year goes on, maybe start to moderate. I'm not sure that that's, going to be quite as steep as the expectations, but it does, to me, really cast a shadow on how much time, we should ever spend trying to predict things, right? The Fed and market participants aren't terribly good at it either. All of us, probably not the best, use of our own time to try to forecast where these are, but rather to try to just, prepare and plan as best we can. And so that got me thinking about, well, if that's the case, what should I maybe consider and try to plan for? And so, the Fed did put out their stress test scenarios. And while I'm not advocating any of us do any of this, I think it's at least interesting to look at, the metrics or the ratios or the measurements that they are monitoring or having the large banks monitor for their stress test. And you can see it's some measures of economic activity, a few measures of asset prices and financial conditions, and then obviously measures of interest rates. So again, I just thought if nothing else, it's at least interesting to see, what they're looking at or having the large banks consider for their stress test scenarios for 23. The baseline scenario to me was also very interesting, right? Where they anticipated, unemployment rising to about 5% into next year. So that's a pretty moderate increase. GDP growth declines in the middle of the year. Inflation moderates into 2024. And then obviously you can see the rise in interest rate or treasuries then declining as we move closer to 2024. Excuse me, the severely adverse scenario, though, is pretty punitive, right? Unemployment rises to 10% in 2024 and a pretty deep recession in terms of GDP growth. So again, I think, the baseline seems closer to where we've been. But certainly if you're thinking about what they're having the large banks anticipate or model for, again, I thought this was at least interesting to take into account. And again, you can see at the bottom, they, in that severely adverse scenario, have them model housing prices falling 38%. So, pretty punitive stuff for the severely adverse scenario. Interest rates will certainly, and interest rate risk will continue to be at the forefront along with liquidity as we move through 2023. Like I said, I think the Fed will continue to raise rates as that's what they've said. So we'll obviously need to remain vigilant on credit quality, liquidity, and interest rate risk. The yield curve all through 2022 suggested, slower growth in a recession. We really haven't hit that yet. So, you always ask, is this time different? But I do think, whatever path we're on, we're going to continue to slow. So it does beg us the question for us, or not even the question, but just the vigilance to kind of start to, normalize if we do start to see weakness in any areas of our loan portfolio. I think for all of us, interest rates, with them remaining elevated, will continue to cause issues with our securities portfolios and our liquidity. But then obviously repricing our local markets will be a challenge throughout the year. And so I think, for a lot of us, that's really going to be, issue number one, is to see what happens with our cost of funds in 2023. I think it's just a reminder that, declines in credit quality can, further exacerbate liquidity issues. So, I think we want to certainly make sure we're monitoring our contingency funding plans, certainly given the maybe the off limits of our securities portfolios. We did see banks under $3 billion borrow from the discount window from the Fed at the highest rate in 2 years. So certainly, because banks are carrying less cash on hand, borrowings are increasing. And so we're just going to want to monitor our liquid assets to assets, certainly reevaluate and monitor our contingency funding sources. So if we can help, certainly, let us know and reach out to us. So at this point, I'm going to turn the presentation over to David, and David's going to walk us through some of the credit metrics from last year. David, the screen is yours.
Great, sir. Well, thank you very much. It's always a pleasure, indeed, to join you, Sean, and with this quarterly update. Presumably, you can see the screen.
Yes, I can.
Good. Well, you almost feel, as a credit guy, you feel like the Maytag repairman. Nobody's still calling. And the metrics that I'm going to show you continue to be pretty stellar, pretty benign. And certainly the polling that occurred at the outset of this discussion here today, or this presentation, would indicate that credit still remains a little bit of a back burner in terms of people's concern. I do think it's important to, however, say I spend a lot of time with trade groups and with lenders and credit people, and I think there's a universal sense that we have to be vigilant still because of particularly all the rate increases and the inflation in particular, if nothing else. So let's talk a little bit about these still very benign numbers. As you know, call report numbers tend to be very still backward looking, but still good numbers. What you see, the inventory to the left of NPLs, the only headliner in that perhaps is the Northeast states, spurted up a little bit in terms of being a little bit ahead of the pack. Charge-offs remain inconsequential. The classic way of looking at reserves to loans, you've basically got the West at the highest coverage, and you got the Northeast states at the lowest. So the little blip up by the Northeast, would love to see some of that diagnosed in terms of what's making up that. I don't know whether it's some of the income property or office space that we'll talk about in a little bit that is making up some of that increase in NPLs. The kind of inverse of that we prefer looking at sometimes is how much of your reserves are covering your acknowledged problems. Again, those tend to be the Southwest at the top are covered, the Northeast at the bottom. But again, in all cases, you have at least 2.5 to almost 4 times the acknowledged problems already covered by your reserves. That's not even to talk about capital, although we understand at least the paper degradation of capital in the last year or so with the impact on the investment portfolios through rate increases. As far as our traditional concentrations that we tend to look at, and particularly in real estate, we've got the Southwest in the higher and the Southeast in the next higher. That's not uncommon because these are areas that are purportedly the most demographically appealing in terms of relocation and construction and industrial activities, which you would expect that would carry over into this subset of the real estate concentration, which is of course the 100% of your capital. As far as the broader 300% guidance, and it is guidance, you have basically the West being the higher level of regional states, and the Midwest being the lower in terms of exposure in that. Other concentrations, multifamily to the right, to the left. You've got the C&I chart in the middle, which obviously the big spurt up of now a year and a half to almost 2 years ago was the PPP program. I think there was certain bankers who believed very much, remember these numbers are under $10 billion of banks and assets under $10 billion, believe that one of the great advantages community banks had, because they really did lead the parade on being the dispensers of PPP loans, is that some of those relationships might be retained at the community bank level to further diversify against so much real estate concentration. But it seems that that's pretty much returned back to kind of the norm in terms of exposure. Ag, of course, not unpredictably, the Midwest tends to be. These are not farm credit system numbers. These are strictly commercial bank numbers. As far as loan growth, Sean's already alluded to it. Stellar rebound. You heard this broadcast a year ago. We were really wringing our hands over very, very tepid and very weak loan growth. Particularly as you were washing out the PPP activity, but that's come back in the last 2 quarters very robustly. One of the charts I continue to use, which I think is still a reality, is that commercial purpose lending is now, according to an expert from Piper Sandler at the recent Bank Director AOBA conference said, now as much as 57% of all CRE and C&I lending is funded by non-banks in our economy. So that is another headwind that commercial banks and particularly community banks are still facing in the open marketplace, that your competitors for commercial purpose loans, arguably much less regulated, is really now taking the majority of that funding away from commercial banks. One of the things that I think is very interesting here for me, and this is just, it is what it is, the loan growth that we've just talked about in the last, particularly 2 quarters, has now created a 12-month growth rate that is absolutely at or perhaps even exceeding the pace that occurred right before the so-called Great Recession, right before we hit the skids in 2008. And it does conjure up that whole issue about vintage, because we do know that going back 15, 12 years ago, that the most toxic of loans that surfaced in the Great Recession tended to be those loans that had been made in the previous year prior to the downturn. And again, whether these numbers mean that or not, it's very specious to presume that they exactly do. But the reality is, with this type of loan growth, if we did have any kind of slowdown in the economy or increase in credit stress, we certainly have to keep an eye on where that vintage loan growth has been coming from in our bank portfolios. Of course, this has been alluded to. In the last 10 years, the rates have been significantly increased at a record pace in the last year in particular. Again, this goes back a decade, but look in the last 50 years. I mean, relatively speaking, we're nowhere near to the level that many of us experienced if you were in the banking industry during the 70s, late 70s, early 80s, in terms of where rates were. So credit concerns from a general standpoint. Again, we've talked about the impact of inflation and rates. We know that almost invariably is going to create some degree of credit stress down the road. We just don't know how much. Again, most people, and particularly the credit and risk specialists, believe these benign numbers just can't last at quite the level they are today. We see in our loan review work clearly that post-booking credit servicing is struggling significantly. Excuse me. Underwriting is excellent for the most part. I think we made a industry-wide improvement in initial underwriting years ago, and that continues to this very day. It is the post-booking servicing that, getting subsequent financial information from borrowers, particularly as they move out of the pandemic, and getting the analysis done in-house by the back shop is seemingly struggling, almost irrespective of the size of bank. We're just seeing it in endless circumstances in our loan review work where people are having difficulty getting resources and the timeliness of the things that are required from a post-booking risk protocol standpoint. As we just alluded to, chasing loan growth could be risky at this point if you're facing some additional credit stress. One of the things that I think more fundamentally give us a little more comfort, and hopefully will give some sense of what those polling numbers said, is in many ways you could look and say that some of the more exotic credit risk has really moved to the non-bank lenders over the last decade. And I do think that's a fundamental that we need to take some comfort in, that we don't have quite as much of that exotic credit risk scattered throughout our traditional loan portfolios as we have. I was speaking to a Michigan group of CFOs conference last week, as a matter of fact, and a lot of the discussion was about loan pricing. And what I have done is taken a little bit of an informal poll with our clients in the loan review world and in the telecredit world. And what I've found to be arguably best practice at this point is not trying to chase the market momentum of rates, but also manage your customer rates within your own margins. What the feedback I was getting was that customers are appreciating that. their customers are appreciating that you're not taking it all the way to the top of the house if you can do it within the bounds of your own margin analysis. Now, regulators continue to fear complacency, but because of all these very benign numbers we continue to show. I will reiterate what I said 2 or 3 times last year. My biggest fear is that overreaction by the regulatory community or even the investment community at the first sign of credit stress, because I think it's just human nature that we really become so used to having just incredibly benign credit quality for many, many years now. As far as what comes out of our due diligence work, and we're still doing some due diligence work. It's not been a very robust year, 2022, for due diligences, but we were involved in a couple of fairly complex ones, actually about 3, I think. And we're still seeing some concern about really rapid run-ups in loan growth at target institutions, which needs to be looked at, disparities in risk grade distributions. Again, the subpar post-booking credit servicing is certainly rearing its head in due diligences, as well as loan review has said. There have been, and I talked about some of the exotic lending being off the balance sheet. We've run into a few banks where they've really tried to buttress their loan growth by taking on what arguably would be considered non-traditional commercial lending, or if you like, more specialty lending. And in some cases, they haven't done so with the appropriate protocols that are unique to those types of loans. ABLs, asset-based lending, things of that nature, or highly leveraged lending. It's nothing wrong per se with that if you're doing it with the proper protocols and you've got risk protocols and you've got the appropriate reserves in place. There's nothing wrong with that on its face. But what we have seen in a couple of cases where banks have been a little bit laggards to impose or structure risk protocols that would attend to the silos that they're trying to seek some lower loan growth in. We do see some cases where there's been some disproportionate exposure to consumer purpose lending in some banks. And again, much of the consensus by regulators, and I think even investors, is that some of the first wave of credit stress may hit some of the consumer purpose loans first. In fact, I think we're already beginning to see some of that data come out of the credit union space. And of course, credit unions have disproportionate exposure to consumer purpose lending compared to commercial banks these days. Again, some of the over-reliance, it sounds like a 30 or 40-year-old issue, but we have seen some cases where banks have kind of reverted back to LTV versus debt service or cash flow focus. Some of that's exacerbated by the lack of financial consistent information coming out of the pandemic. One of the clear topics that come up in due diligence is, I think, is interesting comment here, is that the yield mark clearly has exponentially more energy around it than the credit marks in the current environment for M&A due diligence, which is probably not surprising to those on the call today. One of the things that we've tried to put together here is just we're not economists and we're not experts necessarily, other than we see anecdotally what we see in our loan review work, but we also get commentary periodically from the primary bank regulators. And I would say the highest risk remains CRE office and retail. Consumer, and I do mean in terms of consumer, I'm talking about kind of the certain consumers. There are certain consumers that are tied to, they feel like their 401ks or their investments in the market have given them a more sense of confidence to keep spending, but consumers that are still kind of living paycheck to paycheck and are perhaps more proportionally impacted by inflation, there are some indications that that spending by consumers is beginning to slow down. We'll go back to office space. I know that First Citizens here in Raleigh just acknowledged that part of the CIT portfolio that they acquired last year was showing a little more than they had been expecting, even delinquencies already arising out of the office space portfolios. And then small businesses, because as consistently as the regulators have said, they just simply don't have the balance sheets to withstand just continued inflation. Moderate risk, CRE, hospitality, and specialty lending. I add hospitality largely because while on the face of it, hotels and hospitality has returned with almost reckless abandon with a lot of the tourism and consumer travel. But one of the experts that I do trust spoke to a conference in California a few weeks ago, who warned that he felt like one of the fundamental structural pipelines into hospitality had been permanently altered by the COVID pandemic, because a lot of the business, particularly mid-tier business personnel, are not going to be back on the road traveling to seminars and conferences quite to the level that they had been pre-pandemic, because they understood, the advantages of doing certain types of communication by, virtual Zoom, that type of thing. So again, specialty lending is something, because much of it has a high degree of leverage associated with it, I think would be moderate. Lowest continues apparently to be agriculture. Again, that at this particular point in time seems to be about one of the strongest industries we have going in our economy. Again, these are based pretty much on our anecdotal due diligence and loan review findings and regulatory comment. So the source of the complacency is obvious. We've alluded to it, all these really almost a decade plus of almost flatline concern about charge-offs and non-current loan rates. But I did pick this up in one of the latest FDIC quarterly reports, and it does show a good bit of an uptick in 2022 to assets of problem banks under the supervision of least of the FDIC. So I certainly do think that is a graphical depiction of a little bit of a significant uptick in that regard. Certainly something we need to keep an eye on. We've talked a lot about it at IntelliCredit, and those of you who've heard me in previous quarterly broadcasts talk a good bit about how optimal coordinated credit management should move forward, which is more synchronization of portfolio analytics, loan review, and stress testing. Just wanted to reiterate that I still think that is a very, very optimal goal for all banks to make sure they improve in all three of those categories. In particular, I'd like to focus a little bit on loan review, and that is emphasize experience. I think what is going to be very, very important the next 2 or 3 years, as we probably get into some more credit stress, is to make sure that your loan review function is imbued with reviewers that have experience, that can, in effect, apply the power of persuasion to your credit teams, and not just treat loan review as a checklist item. I'd certainly advise you to start asking for bios in your RFP process for loan review. Now, why is this of concern to me? Credit in many ways is a bit of a pyramid of a multitude of quantitative, or what I call mechanistic calculations. But it's pretty much always capped off by a qualitative or an experience-based decisioning. And that's where experience and even the review workers and reviewers, I think, comes into play. And I think will certainly be an asset for all banks going forward if you focus on that. The other piece is just portfolio analytics. And I think just the ability to make sure you accept the fact that you're sitting on your portfolio's unique DNA. Only you see it. Only you see it. The investors don't see it. Even the regulators don't see it. Your peers don't see it. The regulators see it when they're in the throes of an examination of your bank. But in many cases, particularly community banks, are still underutilizing or underanalyzing the richness of their loan portfolio data. And I do believe that taking steps, and we're certainly dedicated to that at IntelliCredit as we paired a very robust tool called Portfolio Analyzer along with our loan review, that you understand the nuances of your individual portfolios and early detection, figuring out those hotspots. Remember, I think the biggest single investment of good work from your bank will be that your capability of writing your own credit script or credit quality script in the next few years, because I do think you're going to be on a little bit of a defensive around explaining the upticks in some credit stress that may occur. So at this point, I will certainly hand it back over to Sean. It always, again, is a pleasure to be with you, and we look forward to working with you in the future.
Okay, thanks, David. I'll take back the screen. Bear with me 1 second. I should have moved all my slides forward. So let me get to where you were. I should have had mine updated. Sorry. I'm going to roll through these quickly. Okay, let's see. They're almost there. Okay, so here's where I wanted to get. I should have had this ready. Apologize for that. But we just wanted to share with you, many of you may have seen this in an email from me, but David and his team have been very busy. We have 50 active clients in 24 states. They conducted 74 loan reviews last year. We had third parties who use our software conduct another 84. So, David's group has always been long on experience, obviously new here at QwickRate, but certainly encourage you to reach out and talk to David if you are thinking about at least, quoting your loan review and learning more about our applications that do include the Portfolio Analyzer and our internal applications for your loan reviews and annual reviews. So a lot of exciting things, more growth and building to come on the application. So certainly inquire to those as you can. As just a reminder, and the services are broken down a little bit by loan review services that are performed by our David and our team of experts on an external basis, but there are applications that you can use with your own team and your own review functions within the bank. Again, we continue to try to build out the ways to, hopefully benefit you. Obviously, many of you worked with us last year and continue to work with us on CECL. Obviously, the majority of you have come to us initially through QwickRate, our non-brokered CD marketplace, and then, as we mentioned, IntelliCredit. Just a reminder on the different things that QwickAnalytics provides. I know for some of you may or may not have seen the announcement by SNL that they are, sunsetting the SNL banker. So if you are looking for a new service, you can certainly reach out to us. A couple of reminders just on future events. We will have another coffee talk for CECL on March 24th. Paul Allen from Saltmarsh will join us for that. And then tomorrow, for any of you who are still just want a little bit of a refresher on the CECL Solver application and QwickAnalytics, we have a webinar on that tomorrow as well. Okay, I think, let's see. Yep, I think we just got a few more questions and comments about the copy of today's slides. So yes, tomorrow I would think you'll see an email with a link to today's recording, as well as a copy of the slides we used today. Certainly in the interim, you can reach out to us at info@quickrate.com and ask any questions. You can certainly reach out to David and the team at IntelliCredit. So, again, thank you all very much for continuing to support the webinars that we do. It means a lot to us that you show up each quarter. We very much appreciate that. And without any further questions, we'll let you get back to your day, and we'll look forward to seeing you. For many of you, we may see you at the ICBA convention coming up, or David will be at a number of the state association events throughout the year, as will I. And we'll look forward to seeing and speaking to you soon. David, any final comments before we let the group go?
No, sir. I think, again, I just reiterate how much we enjoy working and seeing our customer base. I saw a number at the ABA Community Bank Conference, and again, look forward to the ICBA conference in Honolulu.
All right. Perfect. Thank you, David. Thank you, everybody, for joining today. Let us know if we can help. I'll leave this slide up here for just a little bit longer with our number and the email to, if you have questions, and then look for an email from us tomorrow with a copy of the slides and a link to today's recording of the presentation. Have a great day, and thanks again.